All right, picture this for a second. It is the summer of 2026. The sun is blazing, everybody on Wall Street is supposedly on vacation in the Hamptons, and yet the stock market is quietly pulling one of the sneakiest moves we have seen all year. While most people scroll through vacation photos, something strange is happening under the hood of the market. And if you are not paying attention, you are going to miss it completely. Here is the twist. For most of this year, the story has been simple. Big tech goes up, everybody gets rich, repeat. Nvidia, Apple, Microsoft, the whole gang, they have been carrying this market on their backs. Like a group of superheroes who just discovered a gym membership. But now, quietly, almost sheepishly, a completely different group of stocks is sneaking up to the front of the line. Healthcare stocks, financial stocks, the stuff your grandpa owns, the stuff that sounds boring at a dinner party, and they are hitting fresh all-time highs, while the shiny tech names take a breather on the sidelines. So today we are going to dig into exactly what is going on with this rotation, why healthcare and financials are suddenly the cool kids again, why August and September have this spooky reputation among traders, and why the midterm elections coming up in November are already casting a long shadow over everything. Stick around, because by the end of this video, you are going to understand this market shift better than half the talking heads on financial television, and honestly, you might even laugh a couple of times along the way, because we are not here to bore you with spreadsheets. We are here to tell you a story, and this story has plot twists. Before we get into it, if you are new here, welcome. This channel is all about breaking down what is actually happening in the markets, without the jargon, without the fear-mongering, and without pretending we have a crystal ball, because nobody does, not even the guy on television, with the sound effects and the props. If that sounds like your kind of thing, go ahead and hit subscribe, because we are going to keep doing this every single week, and trust me, the market never runs out of drama. Okay, let us set the scene properly. Over the last couple of weeks, something has been bubbling under the surface of this market that most casual investors have not noticed yet. The headlines have all been about earnings season, and rightfully so, because the big tech names have been putting up genuinely wild numbers. Amazon jumped double digits after a blowout cloud computing report. Alphabet and Microsoft have been grinding higher too. It has been, by almost any measure, one of the stronger earnings seasons in recent memory, with the vast majority of companies beating expectations and corporate profit growth, running at a pace that would make even the most cynical analyst raise an eyebrow. But here's the thing about markets that nobody tells you when you are getting started. A rising tide does not lift every single boat the same way. And sometimes the boats that were sitting quietly in the harbor start moving faster than the flashy speedboats that were doing donuts and making all the noise. That is exactly what has been happening with healthcare and financial stocks. While the market has obsessed over chips and artificial intelligence, and whichever company just announced a new data center, the size of a small country, healthcare names have been climbing steadily, methodically, and now, finally, breaking out to brand new all-time highs. Think about the sector for a second. Healthcare is not exactly known for being exciting. Nobody makes a viral video dancing about a pharmaceutical benefit manager. Nobody screams with joy over a hospital equipment supplier. And yet, that is precisely the appeal right now. In a market that has been white-knuckling its way through wild swings in memory, chip stocks and semiconductor names, healthcare offers something incredibly boring and incredibly valuable. At the same time, which is predictability. People need medicine whether the economy is booming or slowing down. People need doctors, whether interest rates are at 3% or 13%. That kind of demand does not care about the Federal Reserve. And in a market that has been nervously watching every word out of the Fed, chair's mouth like it is a hostage negotiation, that kind of stability starts to look very, very attractive. And it is not just healthcare. Financial stocks have been riding a similar wave. Banks, insurance companies, asset managers, all of them have been quietly grinding to record levels, while everybody was distracted by the AI trade. Part of this makes intuitive sense, if you think about it for even a minute. Interest rates have been elevated for a long stretch now, and higher rates for longer periods generally mean banks can charge more for loans, while still paying out relatively modest amounts on deposits, which is basically the entire business model of a bank in a nutshell. It is not glamorous, it will never trend on social media, but it is profitable, and profitable tends to win over the long run, even if it takes a while to get the recognition it deserves. So what we have here is a genuine changing of the guard, at least temporarily. The market has been leaning so hard into growth, stocks, into anything with the letters A, and I slapped onto a press release, that valuations in some corners of the technology sector have stretched to levels that make even bullish analysts a little nervous. And when valuations get stretched that far, it does not take much of a nudge for money to start looking elsewhere for a home. That is exactly what a rotation is, in the simplest possible terms. It is not necessarily that investors hate technology stocks now. It is that some of them are looking at the math, looking at the risk and deciding that maybe, just maybe, it is time to take a little bit of chips off the table. Pun very much intended, given everything going on with semiconductor stocks lately, and park some of that money in places that feel a little less like a roller coaster and a little more like a nice, steady escalator ride. Now let us talk about the poster child for all of this chaos, because you cannot tell this story without mentioning the wild ride that has been happening in memory chip stocks. If you have been anywhere near financial media this year, you have probably heard about the absolutely jaw-dropping run that a company like SanDisk has had. This stock, which most people had probably never thought about twice in their entire investing life, suddenly became the hottest name in the entire market, rocketing up by hundreds of % as the artificial intelligence boom created an insane demand for memory chips. For a while there, it genuinely felt like the stock could do no wrong. Every single day it was making headlines, every single day. Traders were piling in, terrified of missing out on what looked like the trade of the decade. And then, almost as quickly as it went up, it started coming right back down. After peaking at levels that seemed almost fictional, the stock proceeded to shed more than half of its value in barely over a month. Half in about a month. That is the kind of move that either makes you an instant millionaire or completely wrecks your portfolio, depending entirely on which side of the trade you happen to be standing on, and honestly, depending on which day you happen to check your account. This is the exact kind of volatility that keeps risk. Managers awake at 3 in the morning, staring at the ceiling, wondering if they made the right career choice. Here is the important lesson buried inside that wild chart, and it connects directly to everything we are talking about today. With this rotation into defensive names, when a trade gets that hot that fast, it tends to attract every type of investor imaginable, from serious, long-term believers in the artificial intelligence supercycle, all the way down to speculators who could not tell you what the company actually manufactures. If you held a gun to their head, they just saw the chart going up and wanted a piece of it. That kind of crowd creates incredible momentum on the way up, but it also creates incredible fragility, because the moment sentiment shifts even slightly, everybody tries to run for the exit at the same time, and there simply is not enough room in that doorway for everyone to get out cleanly. So when you zoom out and look at the bigger picture, you start to understand why some of the smarter money in this market has been quietly shifting away from these high-flying, high-volatility corners of the tech and semiconductor world, and moving towards sectors that frankly put people to sleep at cocktail parties. Healthcare and financials are not going to give you a headline, grabbing 85% single-day pop, but they are also not going to give you a 50% gut punch in a single month either. There is something to be said for sleeping soundly at night, and apparently a whole lot of institutional money agrees with that sentiment right now. Let us pivot for a second and talk about why this timing matters so much. Because this rotation is not happening in a vacuum. It is happening right as we enter what has to be one of the spookiest stretches on the entire calendar for stock market investors. And no, we are not talking about Halloween just yet, even though that is coming too. We are talking about the notorious seasonal weakness that tends to show up in August and September. If you have spent any amount of time around old school traders, you have probably heard some version of the phrase sell in May and go away. It is one of those Wall Street sayings that gets repeated so often, it almost becomes a cliche, kind of like how every barbecue has that one uncle who insists he invented the secret sauce recipe. But cliches sometimes stick around because there is a kernel of truth buried inside them. And when you actually look at the historical data, late summer and early autumn genuinely have a track record of being choppier, weaker periods for the stock market compared to the rest of the calendar year. Nobody has a perfectly clean explanation for why this happens every single year like clockwork. And if anyone tells you they have cracked the code on exactly why markets get wobbly in August, you should probably run in the opposite direction. because that kind of certainty in this business usually means someone is trying to sell you something. But there are a few reasonable theories floating around. Trading volume tends to thin out over the summer. Because, shocking revelation here, actual human traders like to take vacations too. And when fewer people are actively participating in the market, price swings can get a lot more dramatic on both the upside and the downside, because there is simply less liquidity cushioning the moves. It is kind of like a swimming pool, with only 3 people in it instead of 30. Every single splash creates a much bigger wave. On top of that thinner trading environment, September in particular has picked up a reputation over the decades as historically being one of the worst performing months of the entire year for major stock indexes. Again, nobody can point to one single smoking gun reason why, but when you have decades of data, all pointing in a similar direction, seasoned market participants start to take notice, even if it is more of a soft pattern than an ironclad rule. Think of it less like a scientific law of physics and more like that friend who always seems to get a cold right when the seasons change. You cannot prove exactly why it keeps happening, but you sort of start planning around it anyway. So layer this seasonal weakness on top of everything else. We have already discussed the stretched valuations. In some corners of the tech trade, the wild swings we just witnessed in memory chip stocks, and the general sense that the easy money in some of these high-flying names might have already been made, and you start to see why defensive sectors are becoming an increasingly attractive place to park capital, heading into what has historically been a bumpier stretch of the year. Now let us bring in the other major character in this story, because we cannot talk about risks heading into the fall without talking about politics, and specifically the upcoming midterm elections in November. If you thought the stock market got nervous about interest rate decisions, wait until you see what happens when the entire balance of power in Washington is potentially up for grabs. Midterm election years have their own peculiar relationship with the stock market, and it is honestly a fascinating pattern once you dig into it. Historically, the period leading up to midterm elections tends to bring increased volatility, and it makes a certain amount of intuitive sense if you think about why markets, more than almost anything else, absolutely despise uncertainty. Give a portfolio manager a clear, predictable path forward, even a mildly unpleasant one, and they can build a strategy around it. But hand that same portfolio manager a giant question mark about which party might control Congress, what regulatory changes might be coming down the pipeline, what happens to trade policy, what happens to fiscal spending, and suddenly a whole lot of very smart, very well-paid people start hedging their bets, instead of confidently pushing all their chips onto the table. This uncertainty tends to be even more pronounced this particular election cycle, given everything else swirling around in the background. We already have a Federal Reserve navigating an unusually turbulent leadership transition. We already have ongoing conflict in the Middle East, creating energy price pressure and complicating the inflation picture. And now you are stacking a contentious midterm election on top of that entire pile. It is a little bit like trying to juggle while riding a unicycle, except the unicycle is also on fire, and there is a slight chance someone hands you a 4th ball halfway through the routine just to see what happens. Here is where the defensive rotation story connects directly. Back to the political calendar. Healthcare policy in particular tends to become a major talking point during election seasons, for better or worse, and financial regulation is almost always somewhere on the docket, depending on which party looks likely to gain ground. You would think that kind of political spotlight might actually scare investors away from these sectors rather than toward them, but historically it often works the opposite way. These are massive, deeply entrenched industries with enormous lobbying, power, and business models that tend to persist, regardless of which party holds the majority. A change in Washington might shift the margins around at the edges, might create a headline or two that spooks the stock for an afternoon, but the fundamental need for banking, services, and medical care does not evaporate just because control of the House of Representatives changed hands. That durability is exactly the kind of quality investors go hunting for. When the political weather forecast looks uncertain, let us take a quick pause and have some fun with this, because I promised this would not just be a dry lecture. Imagine the stock market as a giant house party. All year, the party has been happening in the kitchen, where the artificial intelligence and semiconductor crowd have been doing shots and breaking dance moves nobody has seen before. Meanwhile, over in the living room, Healthcare and financial stocks have just been sitting on the couch, quietly nursing a glass of water. Now, as the party winds down and people start worrying about the hangover, more guests are wandering out of the kitchen and quietly taking a seat next to the sensible folks on the couch. Nobody wants to be the one still doing tequila shots when the lights come on, and everyone realizes it is 4 in the morning on a Tuesday. That, in a nutshell, is what a defensive rotation looks like in practice. It is not usually a dramatic single-day event where everybody simultaneously sells their tech stocks and buys pharmaceutical companies. It tends to be a slow, grinding shift in capital flows that plays out over weeks and months. And by the time the average retail investor notices it, happening on the evening news, institutional money has often already been quietly repositioning for quite some time. Let us dig a little deeper into specific names, because talking in broad sector terms only gets you so far. On the healthcare side, we have seen strength across a genuinely wide swath of the industry, from pharmaceutical giants working on blockbuster drug pipelines to insurance and managed care companies, benefiting from more stable premium pricing, to medical device makers riding steady, unglamorous but consistent demand. This is not a story of one miracle stock, carrying the sector the way certain semiconductor names have carried tech this year. It is a broad, sector-wide lift, which tends to be healthier and more sustainable than a single company, doing all the heavy lifting. On the financial side, banks have benefited from elevated interest rates, persisting longer than a lot of forecasters expected. Earlier in the cycle, plenty of economists confidently predicted rate cuts that simply have not fully materialized. Every month, rates stay higher. Banks keep collecting a wider spread between what they charge borrowers and what they pay depositors, which flows fairly directly to the bottom line. Add resilient loan demand and healthy consumer balance sheets, at least for now, and you have a sector quietly compounding gains, while everybody else watched a completely different show. Now I want to be fair here, because it would be irresponsible to tell you technology stocks are somehow doomed, or that everybody should abandon ship and pile into healthcare and bank stocks tomorrow morning. That is not what is happening, and it is not what a healthy rotation looks like. The earnings coming out of the technology sector this quarter have genuinely been impressive by almost any historical standard. Real substantial growth, not just hype about a future that may or may not arrive. Cloud computing revenue has been strong. Advertising revenue tied to AI-powered products has been strong. The fundamental growth engine of the technology sector has not suddenly broken down overnight. What has happened is more nuanced than a simple binary story of tech bad, defensive good. It is really a story about valuation, about risk, appetite, and about investors becoming a little bit more selective and a little bit more cautious after an extraordinary run higher. In some of the more speculative corners of the market, think of it less like the party ending completely and more like the party simply maturing a little bit. The music is still playing, people are still having a good time, but maybe a few more folks are ordering water between rounds, instead of doing back-to-back shots every 5 minutes, because everyone remembers what tomorrow morning felt like the last time this happened. Let us talk about what this actually means for you, the person watching, because understanding market dynamics is only useful if it informs how you think about your own money. First and most importantly, nothing in this video is personalized financial advice. I am not your financial advisor. I have never met you. I do not know your risk, tolerance, your time horizon, or your existing portfolio. Please do your own research or talk to a qualified professional before making any investment decisions based on anything you hear in a video on the internet, including this one, and especially anything from that one guy screaming on financial television with the sound effects. With that important disclaimer firmly out of the way, let us talk about what this rotation teaches us, more broadly about how markets actually function, because there is a genuinely valuable lesson buried in here that goes well beyond just healthcare versus technology stocks. In the summer of 2026, the first big lesson is that diversification, as boring and overused as that word has become in personal finance, content actually matters in moments exactly like this one. If your portfolio was concentrated in the hottest artificial intelligence and semiconductor names this past year, you rode an incredible wave higher, no question. And congratulations if you timed it correctly. But concentration cuts both ways, and when the wind shifts, as we clearly saw with the wild swings in memory, chip stocks, that concentration can turn from your greatest strength into your biggest vulnerability overnight. Exposure across different sectors, including boring corners like healthcare, and financials can provide a genuine cushion during exactly these transition periods, even if it means giving up some upside during the euphoric phase of a bull run. The second lesson is about paying attention to what is happening underneath the surface of the headline index numbers, rather than just glancing at whether the overall market went up or down on any given day. The S&P 500 as a whole can look calm and steady, quietly grinding to new all-time highs, while underneath that calm surface, there is a genuinely significant rotation happening between sectors, styles, and themes. If you only ever look at the top line number, you miss the entire story. The third lesson, probably the most important one for long-term investors, is that seasonal patterns and political calendar events, like midterm elections, are worth being aware of. But they should never be the sole basis for dramatic changes to a long-term strategy. Yes, August and September have a reputation for choppier trading. Yes, midterm years tend to bring elevated volatility, but historical patterns are tendencies, not guarantees, and plenty of Augusts have been perfectly lovely for returns. Treating these patterns as one input among many is reasonable. Making all-or-nothing bets purely on a calendar page is riskier, kind of like refusing to leave the house every Friday, the 13th, because you stubbed your toe on one decades ago. Let us circle back for a moment to that memory chip story, because it illustrates everything we have been discussing. When a single stock experiences a parabolic move higher, followed by an equally dramatic reversal, it tends to shake confidence not just in that stock, but in the broader theme around it. The underlying demand story for artificial intelligence infrastructure has not disappeared, but the violence of that pullback has made some investors gun-shy about chasing similarly hot trades in the near term. And when investors get gun-shy about momentum, the capital often flows toward exactly the kind of steady, predictable sectors we have been talking about. This is all playing out against a genuinely unusual macroeconomic backdrop, too. We have a relatively new Fed chair, navigating his early months during heightened geopolitical tension, inflation running above target, and a bond market sending loud signals of its own through rising long-term Treasury yields. With that much uncertainty around monetary policy, defensive sectors become more attractive, since their earnings tend to be less sensitive to the exact path of interest rates than a highly leveraged growth company, depending on cheap capital. Let us bring this together and think about where things might head from here, while being humble about the fact that nobody has a reliable crystal ball for what the market does next. If the historical seasonal pattern holds this year, we could see continued choppiness through August and September, with healthcare and financials potentially continuing to outperform, especially if bond yields stay elevated, and the Fed maintains its cautious posture. At the same time, it would be a mistake to write off technology entirely, based on a few weeks of relative underperformance. These remain extraordinarily profitable companies with genuine growth. Drivers and markets have a long history of punishing anyone who tries to permanently count out the biggest companies in the world. If earnings keep coming in strong, technology stocks could absolutely regain leadership once the market works through this bout of nervousness. As November approaches and the midterms actually happen, expect volatility to pick up further in the weeks surrounding the vote itself, since markets hate uncertainty, right up until the moment it gets resolved, at which point win, lose, or draw markets frequently move on and refocus on fundamentals fairly quickly. The anticipation tends to create more volatility than the actual resolution, kind of like how the week before a big exam is somehow always worse than the exam itself. So what is the takeaway if you had to boil this whole video down to one idea? Pay attention to what is happening beneath the surface of this market, not just the headline index level. Right now, that means recognizing a genuine rotation away from the hottest, most crowded technology and semiconductor trades towards steadier, defensive sectors like healthcare and financials hitting fresh all-time highs, even as parts of the tech trade take a breather. This is happening against seasonal weakness that historically shows up in August and September, layered on top of a contentious midterm election in November, while the Fed navigates its own turbulent leadership transition during stubbornly high inflation. None of this means panic, and none of this means abandoning a well-thought-out strategy. because of a scary video on the internet. It means staying informed, staying diversified, and understanding markets are always telling a story if you know where to look. And right now that story is about steady, unglamorous sectors, quietly stealing the spotlight from the flashiest corner of the market, at least for now. If you found this breakdown genuinely useful, do me a favor and hit that like button, because it actually helps this channel reach more people who are trying to understand what is happening in these markets, without all the noise and the fear-mongering you find scattered across so much financial content out there. And if you have not subscribed yet, seriously, what are you waiting for? We are covering exactly this kind of market dynamic every single week, breaking down the headlines, connecting the dots between seemingly unrelated events, and trying our absolute best to make investing knowledge accessible and genuinely entertaining at the same time, instead of something that feels like homework. Drop a comment down below and let us know what you think about this rotation into defensive stocks. Do you think healthcare and financials keep leading the way through the rest of the year? Or do you think technology comes roaring right back the moment this current bout of nervousness passes? I read every single comment, and honestly, some of the best insights on this channel come directly from the discussions happening in that comment section, so do not be shy. Jump in there and let us hear your take. One more thing before we wrap up. If you enjoy digging into the details behind these market moves, check out some of our other recent videos where we break down the wild swings in memory chips, this turbulent Fed transition, and how rising Treasury yields are reshaping the investment landscape. Once you start pulling on one thread in this market, you quickly realize how tangled and interconnected everything actually is, which is exactly what makes this subject so fascinating. Thank you so much for watching all the way through. It tells me you actually care about understanding this stuff properly, instead of chasing whatever headline is trending this morning. Stay curious, stay diversified, keep questioning the narrative. Everyone else repeats without thinking twice. And we will see you in the very next video. Now, before you go, quick recap, just in case you want the short version to keep in your back pocket. Healthcare and financial stocks are climbing to fresh all-time highs, even as the hottest technology and semiconductor names cool off. After a wild run higher earlier this year, this rotation seems driven by stretched valuations. In parts of the tech trade, nervousness, following the boom and bust cycle we just watched in memory chip stocks, persistently elevated interest rates benefiting bank profitability, and a broader search for stability during an uncertain macroeconomic stretch. Layer on the historically choppy August and September pattern, plus an approaching midterm election, plus a Fed chair still finding his footing, and you get a genuinely interesting cocktail, pushing investors toward the steadier corners of the market, at least for now. Does this mean growth and tech are done? Almost certainly not. These remain fundamentally strong, profitable businesses with real growth. Drivers and markets have shown again, and again that writing off the biggest companies in the world is usually a losing bet over time. What we are watching looks much more like a healthy rotation and consolidation phase, catching your breath after sprinting the first half of a marathon a little too aggressively, rather than anything resembling a collapse. Thanks again for spending this time with us today. If this helped connect a few dots, share it with someone else who might find it useful too. We will catch you in the next one. Stay sharp, stay curious, and we will see you soon.